All right, the next concept we're going to talk about is the strong rebound after a shakeout. Now, we've all been shaken out of stocks. It happens all the time. And if you're not shaken out of a stock, then you're really not managing your risk, because sometimes a stock will break out and it'll fail and it'll just keep going lower and lower and lower. So at some point, you need to sell, unless you're just going to turn into one of those long-term holders who hold stocks for years and years and years and waiting for them to come back. And that's not what we do at IBD using the CanSlim system. So at some point, you're going to have to sell your stock, at 7 or 8%. You definitely have to pull the trigger and sell it. And sometimes we sell it sooner. So what do you do when the stock shakes out, but then sets back up and gives you another entry point? Well, you have to step back up and buy those shares back. Now, something that Bill taught me years ago was, if I'm shaken out of a position and I'm buying it back, make sure that I buy the same amount of shares plus a little bit more. And that's just a tiny bit more. So if you bought 1,000 shares and you were shaken out of it, there's nothing wrong with that. And if it sets up and gives you a better entry point, then you go ahead and buy it back. And I like to buy back about 1,100 shares, just a little bit more. There's a little trick that he taught me, gives you a psychological advantage. Rather than coming back in and only buying 300 shares to see that stock turn and run and have a big move, well, you're participating, but not to the same extent that you did the first time. So lots of bad things can happen with that, right? You could say, well, the next time I'm not going to be shaken out, and you're going to hold on a little bit too long, and you're going to turn in something that could have been a small loss into a big loss, or a loss that really gets out of control. So it's a good thing to say, you know what, I was shaken out. Is this right to buy the stock back? And if it is, just buy the same shares plus a little bit more. But what you don't want to do is get in the habit of doing that over and over again and just churning your account of buying a stock, cutting it too close, buying it back, cutting it too close. I did that a little bit too much and got into a bad habit with that. And it's something that you want to really look at the chart and say, you know what, now that it had a shakeout, does it give me a better entry or not? So let's look at Cisco. And this is one of my favorite charts of everything we have in our database. In fact, I like this chart so much that I printed it out on a big sheet of paper, kept it up next to my desk for over a year, knowing that someday another Cisco was going to come along, and I wanted to make sure I knew how to handle it. All right, so how would you have gotten into this stock? Cisco gives you a couple different entry points. The first one is that shakeout plus 3. So as you were forming that left side of that base, it hit a low of 22, and then eventually undercuts that and hits at 1975, and then rapidly turns back up. And so if we added 3 points on that 22, that would give you a nice entry point at 25 using the shakeout plus 3. That ends up being the ideal buy point for Cisco. But it also gives you kind of a standard pivot as it goes through the middle of the W, $27, and 27.10 would be your entry point, but it gaps right up, and it would be very likely that you don't get those shares right away. So you have a higher cost basis if you're buying it through the middle of the W. So that gives you quite a problem as it comes and has its normal shakeout. So the first thing you want to realize is that about half the stocks will pull back into the pivot area. So just because it comes back in does not mean that it's abnormal. And stocks that move really fast, many times they will. They'll come back in one more time just to shake out everybody and then turn and resume their uptrend. So when you're looking at it, you want to know what normal is and what abnormal is. And the only way to do that is just study chart after chart of good bases that worked and faulty ones that failed. And throughout our workshops, we have tons of examples for you to look at, as well as in this book. So if you bought it at the Livermore Shakeout plus 3 at $25, when it has that pullback where you come down for 2 days and then that third day you have a low that closes that gap and turns back up, you probably wouldn't have been shaken out of those shares. But if you bought it off the double bottom with that higher cost basis, pretty likely that you would have been shaken out of some or all of your shares. So what would you do? How would you buy that back? There's different ways that you can handle it. In general, what you're doing is you're saying, is this stock acting right, and does it look like it's resuming its uptrend? And there's an early way to kind of identify that and a little bit later way. And so it's open for your interpretation of where you'd be buying it. And remember, it doesn't always have to be an all or nothing where you buy that full position at one point. So if you're shaken out of your shares and it has a big, what we call an upside reversal during that shakeout. So you come down for 2 days, and then your third day, you're hitting big lows, and then you turn and you close up near the highs of the day. You could start establishing your position back at that point because it's undercut your pivot, it's come back up, and it looks strong. So maybe you start nibbling. Or you could wait until 1, 2, 3 on that fourth day up as you're closing above those recent highs. You could be establishing some of your position there, or maybe just building some of it back. But then on that first day after your red day, that big powerful up day, it's clear that it's resuming its uptrend. So any shares that you've been scared out of, that you were shaken out of, you can buy back. So it's not an all or nothing. You could have gradually been buying your position back, not buying the whole thing on that upside reversal, buying it a few days later. And then again, as this stock is resuming its uptrend, buying those shares back, because you don't want to be left sitting there with no shares or a very tiny position as the stock continues to move higher. And look, it doesn't really look back after that. You get one pullback into your 50-day, which you could be buying off of, and it runs up to $60. So it goes from really a $25 shakeout plus 3 up to almost $60 in a blink of an eye. And that was Cisco. What a powerful move, great story, and that was a great leader in the market for about 10 years or so. Next up is Southwestern Energy, SWN, back in the 05 time frame. And we're going to pick this up in the middle of its move right after this shakeout. So the stock had formed a base on base pattern where you had a little cup without handle, or you could look at it as a cup with handle depending on how you view that short little handle there. Runs up, forms a little flat base, and breaks out with a nice gap up. Really nice move, powerful. You definitely want to be buying that stock on that day. I know I would. And then it immediately turns and starts coming back in. Hits the 34.60, starts pulling back in. This is normal. This is going to happen about half the time when you buy stocks. You want to get that in your mind that it is natural and it's normal. We'd all prefer them to go straight up. I know I would, but they don't all work out that way. So inevitably, you could be shaken out of some or part of your shares as it hits that 30.83 because you just don't know. At the lows on that day, it's not going to look or feel good. And you don't want to have a false sense that every stock is going to turn and go back up. But about half of the model book stocks are big winners will pull back into their 50-day. So how do you handle that when you've dislodged your position? The sooner you realize a mistake and fix it, the better off you're going to be. So on this one, it's a great example where at the lows on that day, as it hits that 30.83, it's not going to look or feel good. If you sold it at the bottom and it closes back up there right at the highs, closing almost unchanged for 3 days in a row, that is just giving you a sense of a shakeout. So maybe you're even buying some of those shares back at the end of the day, just being flexible. That following day, that advance is continuing, so you could be buying some there. Maybe sit back and just say, you know what, I'm just going to wait and see what ends up happening. And as it goes through, on that day that it goes through the 34.60, it's clear that that uptrend is resumed. You don't even have to wait for the 34.60. You could be buying any shares back that you've been shaken out of and look at that move up. So if you're judging it from the beginning of that 31.64 entry point, you've gone up 39% in just a number of weeks. A really, really powerful move. So next time you're shaken out, don't be discouraged. Just realize, look for another entry point and buy the stock back if it looks strong, it's acting strong. And of course, it has to have all the canceling characteristics on the fundamental side before you'd be trading it anyways. So that was Southwestern Energy and a very quick shakeout and a rapid advance. All right, next up is Google. And we're going to be focusing in on this cup with handle that it formed within this larger structure. As we talked about with some earlier charts, there's lots of ways to interpret this, and I could see people looking at it as a double bottom type of formation. I'd like to look at it as a cup with handle next to a different structure. There's really not a right or a wrong way here. So you're buying it as it goes through the peak there, the 418.69, the peak of the handle. And that's a great entry point. It goes up for a day and a half and then just starts backing away. You can see the earnings are about to come out. So no one really knows what to do around earnings. It's very, very tricky. So it breaks out there out of the highs of the handle, acts really well for 2 days, and then on that third day, it starts stalling and backing away, kind of giving you a sense that it just doesn't know whether it's going to go up or down at that point. That's because the earnings are coming out within a week. Many times you'll see this type of action before earnings, and then on the earnings announcement, if they're good and everyone interprets it that way, they gap up. And if people interpret it another way, or they're just really poor earnings, you see those big gap down. So 4 times a year, you have all this volatility in a stock, and it's really, really hard to handle a stock around earnings. So it would be realistic that you would be shaken out of some or all of your shares as it pulled back into that area. Now, relative to a lot of pullbacks, this is really mild and kind of acting normal. And if it wasn't for the fact that earnings were coming out within a couple of days, probably most people wouldn't be shaken out of a position like that. But, if you're buying a stock and it's going into earnings and you're barely up on it, it's realistic that you might have trimmed some of your shares. So what do you do at that point? Well, you've got a big gap up like that. It feels like a breakaway gap at that point, enormous volume. Now the earnings are behind you. You can step up and buy those shares back. It's not ideal. Of course, you would like to never be shaken out of a position. The reality is, as you trade throughout your career, you're going to end up getting shaken out of positions, and you have to be willing to step up and buy them back. And occasionally you're going to deal with a situation like this where it is just gapping up that high. It'd be nice if you bought it the day before, but it could have just as easily gapped down as it did gap up. So on that big gap up, you're going to step up and you're going to buy those shares back. And look, it ends up having a really nice move. It's a little bit harder to hold as it undercut that 50-day for a little bit, but that was Google, and that was just one part of its massive move that it had over the years.